Bulls are on the rampage on Dalal Street, and that's very evident from the frontline indices run, where Nifty and Sensex both are trading at their record levels. And a year-to-date basis too, if we see Nifty 50 and even Midcap index, then they both have been leading with the gains of around 5%, but it's only the Nifty Smallcap index that is still languishing in trade with 13% of the cuts. But therefore, should one stay away from the volatile and the risky small cap companies? And is there a case to invest in small cap funds or not? To help you get a 360-degree analysis and perspective on that today onto the show, we are being joined by our guest Aditya Shah, who is the Chief Investment Officer at JST Investments, and we'll be joined by another guest soon, but shortly. But firstly, let's take the discussion forward with Aditya. Very good evening, Aditya, and thank you so much for joining us today onto the ET Money Show. First of all, let's keep it very basic. Would like to tell our viewers from you that what exactly small cap funds and what are the options that are available when it comes to small cap index investments? Which are the index and exactly how many options our consumers have?
Good evening. First of all, what are small cap funds? Small cap funds are those funds which invest 75% of the total corpus of the mutual fund into small cap companies. How are these small cap companies decided? First 100 companies are the large cap companies. Next 100 companies are the mid cap companies. And after that, all companies are categorized as a small cap company. So these company businesses are just being formed. So therefore, they are very, very volatile. The stock prices continue to remain very, very volatile as business performs sometimes and the business does not perform sometimes. So point number one, these are upcoming companies which have good potential. However, the stock prices will continue to remain volatile. That is something that we need to really see. On the small cap fund, these funds invest 75% in small cap companies and 25% of their investment may be in large cap or mid cap. That's point number one. What are the options available? Most companies have a small cap fund. These funds are invested across from 50 companies to about 100 companies. We have a small cap index as well that is available, but there's no good means to invest in that. You can invest in the Nifty Junior Bs or a Nifty Next 50, Next 50 index. Other than that, on the index side, there's no good option available. Or you can invest in an active fund, which invests anywhere between 50 to 100.
Understand. So not just small cap, Aditya has given a lot many options to be looked forward to. But Aditya, you must have studied so many cycles across, because at one point of time, like you were saying, that all these counters are very volatile. So when in bull run, these counters tend to outperform the markets, but when they are a bit choppy, then they actually underperform a bit. Like in the case this time around, on a YTD basis, small caps are actually, that index is actually down 13%. But in this scenario, what do you think? Is there a case in point to invest in small caps, and what kind of a return expectation should one be having at the current point in time when it comes to the small cap investing?
First of all, point number one, small caps will continue to remain extremely volatile. I remember in 2018, when the small cap index was down 40%, many funds were down 50-60%, and they had to stop inflows because they were not getting good companies to invest in. So point number one, during periods of drawdown, small caps will have extreme drawdowns and many investors will lose faith in these funds. So the volatility will be there. Now, who should invest in these funds? It is very simple. Those who have very high risk appetite and those who can tolerate the ability to take risk and drawdowns of as high as 50% can go ahead and invest in these funds. Now, is it a good time to invest now? In my opinion, a small cap investor should invest in a small cap fund, not for a horizon not less than minimum 10 years. So 7 to 10 years is the minimum time horizon where you should be looking to invest in these funds. It is a good time to invest in these funds because many new small companies will come up as India embarks on the manufacturing cycle and the decade will belong to India. So good time to invest, but only for very high risk appetite investors. You can expect a little bit of higher return from a normal average flexi cap fund. However, my preference for most 99% of the investors will be with the flexi cap fund. Only those 1% investors who have higher risk appetite can start investing through an SIP mode into a small cap fund with a time horizon of about 7 to 10.
Understand, but Aditya, when it comes to mutual fund investing, it's generally advisable that minimum 5 years or so you should be having your money in mutual funds, so to have seen that Kager return that will be very decent for you, as well as could be in double digits as well. But like you were highlighting that for small caps it should be around 10 years or so. So are you saying that for small caps the horizon for investment should be a little bit higher given the volatility when it comes to the index level?
Yes, definitely. So let me give you an example from 2018 to right up till 2020 COVID, about 2.5 to 3 years, we did not see, in fact, we saw negative returns from all small cap funds. And it was very, very difficult for small cap investors to hold on to the small cap mutual funds. So inherently, small cap funds are volatile, and the only way to reduce this volatility is to give them a higher time horizon. So, in my opinion, whenever I suggest some small cap fund to any retail investor, I tell them that the minimum time horizon should be 7 to 10 years. During this period, if you are able to consistently SIP in a consistent and a disciplined way every month, you will find that at the end of 10 years, you have generated a handsome return. So, yes, the time horizon must be longer than a normal flexi cap fund. A consistent and a disciplined SIP of 7 to 10 years will help you generate a far better return than a flexi cap.
Understand, but Aditya, whenever a person is going for mutual fund investing, so generally they tend to go to the website and try to find out which all companies are they investing in. But when it comes to the small cap fund, the information from all these companies is a bit limited in terms of the con calls, and the analyst coverage also is very limited in some of these cases. So when an investor is taking that risk to get into that small cap index investing, what all points he needs to be wary of, and what all things he needs to be prepared of when he's getting into such investing?
Yes, definitely. As you said, smaller companies give very less information. They don't do con calls, and they don't also, the management also does not come in the media. So very, very difficult for an average retail investor to understand what kind of a portfolio does a mutual fund really hold. So what you can really do is you can look at the Sharpe ratio standard deviation of the mutual fund, which tells about the drawdown that the fund really has and tells you about the risk adjusted return. When you invest in a small cap fund, make sure that you have an advisor who guides you properly, because in times of extreme volatility, you will find that if you are unguided, you will give up on the fund whenever there is a 15 to 20% fall. So look at the Sharpe ratio, look at the standard deviation, try to look at the broad 5 to 10 top holdings and see if information is available about them, and then tend to invest. We have some funds which have 100 more than 100 stocks inside the portfolio. Don't go ahead and invest in those mutual funds. Try to invest in mutual funds that hold about 30 to 50 stocks. Those are good enough funds, and those will be able to generate very high returns over a period of 5, 7, 10 years.
That's an interesting point made, because the information is quite very limited for the investors. So one really needs to track the mutual fund performance, and not just that, has to be wary of how many companies the mutual fund is actually investing, because the diversification takes that play. And like Aditya was mentioning, that if one or two companies get trapped in some of the cases where the company is in trouble, then the whole mutual fund performance can be at risk. But Aditya, I have a couple of questions when it comes to portfolio designing, because like you were mentioning that these are some of the risky bets. So what is the age gap that you recommend to your clients, that you are in this particular age gap, so you can actually go for small cap investing, and why, which age gap is this product not made for?
So the small cap product is ideal for people who are anywhere up to 40 years of age. who have at least 10 to 15 years of their investment life horizon left. That's the first point. It is not suitable for somebody who is above 50 or who has retirement that is coming up very, very quickly in the next 3 to 5 years. That's the first point. Second point is, even though they are highly risky products, what is the what is the percentage that you should invest out of your whole corpus? Even though if you are a risky investor, not more than 15 to 20% of your entire portfolio should be invested in small cap. Because small cap brings in a lot of volatility, it is important to balance it with products that are less riskier, less volatile in the short term. For example, a flexi cap fund or a large cap fund. So not more than 15 to 20% of your portfolio should be in the small cap funds. Up till 40, it is fine to invest. Right up till 45, 50, you can continue your SIP if you started early. And by the time you are 50, you should be completely out of the small cap.
Okay, so that could be the portfolio allocation that you should be looking forward to. But Aditya, just a last couple of follow-ups there. As you said, that small cap is volatile, but at this point in time, would you recommend somebody to, in your recommended age group only, that you can actually go for small cap investing, because the markets are very volatile and going forward we have the interest rates rising, and even but though Indian economy is standing strong, but still, do you make a point for small cap investing right now?
Ma'am, point number one, the only thing guaranteed in equity is volatility. Markets will always be volatile. 2021 was an exception. Markets otherwise will continue to always be volatile. And as you also track the automobile sector, we have seen manufacturing starting to come into India. And I believe the next 10 to 15 years will be India's growth, ballistic growth will come to India. India will be the fastest growing economy over the next 10 to 15 years. And small companies here will do extremely well. However, they will continue to remain extremely volatile in terms of stock prices. So, in my opinion, anybody in that time, in that age horizon of about up to 40 years of age, who is just starting their investments, can start to invest in their small cap fund. I continue to recommend these funds provided the age gap is good and you can SIP in a disciplined and a consistent way for at least 10 to 15 years time. And consistent and disciplined SIP is a must. Every month you should go ahead and invest slowly and steadily into these small cap funds.
Thank you so much, Aditya. That was an interesting conversation, and definitely the automobile sector is doing very well, and even the commentaries coming from the management is very much optimistic. So let's keep our fingers crossed that it continues with the growth in India. It was lovely having you on the channel. Thank you so much.